Hey, welcome to the Trade of the Day. Today's theme is how to become an oil tycoon. So, if I was to become an oil tycoon, I would pick a stock like Exxon. Exxon's one of my favorites. I trade them quite a bit. And I would start out by looking at the stock here. This is the price action. So, we got a little bit of exuberance here about oil prices maybe going down. This is a drill baby drill effect that's happening. We had a little bit of a consolidation. It's kind of wedging up, which is typically a bad sign, but it's overall I wouldn't be super concerned because that 105 level seems like a good support, as does that 95 level. So we see here on the MACD line is above the signal line, and we have our RSI above 50. So if I was to want to become an oil tycoon, I would start right here. I would open up my option strat tool. I'll put the trade in the description. If you're interested at it, I get 3 cents if you start a trial, I guess. All right. So what I would do is I put XOM, that's a symbol for Exxon, up here in the upper left corner. I would give myself a lot of time to be right. We tend to do this on the put side when we get the puts a little bit closer to where we are. And we do want to take a position, but we want to take a position at a deep discount. So at 95, that's going to require $950 in margin or thereabouts. If you do this in a non-margin account, your account is going to sequester $9,500 from you. So that will hurt a tad bit to the total ROI for the money being used for it. We end up getting a $117 credit. I would use that $117 credit, and I would immediately buy myself 1 share, not 100 shares, of Exxon. So that is going to give me, you may not be able to see it on your screen, but there's a slight increase that as the price goes up, I'm going to make a little bit more money going forward. I would put a broken wing butterfly on the other side. The reason I go with a broken wing with this hat way out here is just to limit what my downside looks like. My max loss of 114 in a margin account, it's probably not going to pull the full 1411 out of your account, but this keeps the margin that you're using limited. So just in case there's a volatility spike or the price goes crazy, you don't end up using more than that in margin. So that's going to add another $54.50 to our credit. What we're doing is we're buying that 120 call. We're selling 2 125s. 125 is about the all-time high for Exxon, or at least it's been their high over the last 5 years. And then we put the 145 here just to keep everything from getting too outrageous. What would happen over time, let me give us a little bit more range so we can see a little bit more of this. What you have here in the background is the probability distribution. Looks like a fairly normal distribution. We start this standard deviation line. We'd still make money if we had a 1 standard deviation movement. Our max loss is beyond our 2 standard deviation movements, so that's 96% chance that we stay below that. What's nice about taking it as a broken wing is even if we do, because we do have this thing on for quite a bit of time, even if we get all the way out to 30 days remaining and the price starts jumping all the way up here to 122 or even 127 is kind of our break-even spot, that's going to give us the ability to grab one of these short calls. I would probably sell this 145 long call, and I would roll that 125 up and out over time, and that's going to give me another opportunity to be profitable. But I do want to pick up that $500 we're going to make between the 125, the 120 and the 125. So when we pull the whole thing together, we end up with something that looks like this. So we have a short put on the downside. We have a long call at 120, two short calls at 125. This gives us that spike. If I start getting over this point, this 125 point, I start going in the money on one of these short calls, I'm going to take that short call and I'm going to roll it up and out, and I'm going to sell this 145 back if there's any money left on it, extrinsic, of course, and I'm going to help ensure that I build a credit. So that gives me about a 90% chance staying below my break even on the top end. Gives me about a 90% chance of staying above the bottom end, but at the end of the day, I wouldn't really mind picking up 100 shares at 195. One of the great things is I get this one share essentially for free, and I'll be able to pick up that dividend for as long as they are returning dividends. So let's take a quick look at what the return is going to be. So if we decide this is going to be about $950 on the margin side, let's take the full max here. So we'll call that 123 max loss on this side. Hold on a minute, let me try and see if I can find my calculator. There we go. So that ends up being 171 divided by, call it 1500 for a round number. So that ends up being an 11.4% return over a little bit less than 6 months, call it 5 months. That is a pretty good return, and it gives us a lot of options. So if I wanted to be an option and oil tycoon, this is how I would do it. Thanks, everybody. Go ahead and like if you got something out of it, and I'll see you next time. Bye.